Last show of the year, Super Prime UK. Here we are. And James, we have the post-budget special. Everyone is waiting to hear your views. How have you been and what have you got for us today?
Yeah, no, really good. Thanks, Rob, and Merry Christmas, season's greetings to everyone. Let's start in terms of some of the transaction data just before we get on to the budget digest. So in terms of where we're at, let's take October 2025. So in terms of up to 5 million in London, we had 26 transactions. October, 9 in excess of 10 million. As we compare that to the 2024 data, there's quite a big difference there in terms of market activity. So October 2024, there was 42 transactions up to 5 million in London, and 10 million plus, there was 23. So you can see there around 40% less activity in October 25 to 12 months earlier. The November figures aren't quite as far apart. 2025 November, 30 transactions up to 5 million in London, and 10 million plus 9. So if we compare that to 2024, those sort of marry up fairly well, actually. So where we are in the market, it's more accurately highlighted in the October data if we look at October 25 to October 2024.
Yeah, I think we clearly have seen a real slowdown in the super prime space, and that is backed up and supported by the data and the evidence. Everyone knew that was the position. Things have really slowed down. Very, very, very nervous pre-budget. And now that we've had the budget, and I would say better than expected from a sentiment perspective, maybe there's a chance that Q1 2026 performs better than expected, and on a like-for-like basis, better than previous years, on the back of it not being as bad as people expected it to be. What are your thoughts on that?
Yeah, I think in terms of the press, the rumour mill was in full flow leading up to the budget in terms of potential policies and what it might hold. But in terms of how it received, I think received by the market fairly passively, and I think one of the terms that you used, Rob, in our pre-discussion was the deferred budget. A lot of the policies have been slightly deferred, which are coming in at later stages. So the immediate impact of those isn't going to be felt quite in the same way. So we'll see how those are, the detail of how those are implemented and then more latterly received by the market. I think where we are towards, autumn budget, it's quite late in the year to see an immediate difference in terms of any market movement. We're going to have to wait until probably the end of Q1 2026 to see, how buyers react to some of the changes there. There's going to be other factors at play, such as the cost of living, how that's going to affect people more favourably, maybe the cost of finance, if we get another rate reduction before Christmas, if that's going to spike the market. It's probably going to lead people into the market again more in January than affecting any of the sort of December trends of this month, really. And now, given certain clarity on the 2 million plus and some of the sort of dubbed mansion tax as we've got it there, brings a little bit more certainty to the market. Overall, longer term measures, there's slightly greater incentive for those older generation, which might be in sort of by themselves in a larger house. I think the government is trying to incentivize in some way for those people to downsize, maybe through that sort of mansion tax, although the cost of moving is still very expensive and restrictive to a lot of people, not just in that sort of downsizer sector, but those also looking to move up the property ladder. I think that's why we've seen a lot of people extending their houses, if possible, loft conversions, etc., just because that option is so much cheaper than the cost of moving. Rob, just in terms of an early digest there, what do you think the biggest factor is there that's going to affect the market and maybe the economy?
So I think there are two things. I think the deferred budget that you mentioned, I think is is what people are concerned about, in the sense that tax increases or new tax policy that weren't introduced, that were rumoured to be, such as an exit tax, are they now being kicked down the road, or have they been put to bed? And there were people that were rushing around trying to work out their exit strategy to leave the country so they wouldn't be paying this penalty of an exit tax. And does that mean that in the next period they're now going to move forward with that without the pressure because they believe that something's coming in the future? So I think that's one thing. And the second area, I think, is the £1.5 to £2 million space within the residential market in the UK. 75% of that is London and the surrounding areas. And I think with the surcharge, the mansion tax, the council tax surcharge, even though it doesn't come into effect until 2028, when you throw school fees, VAT, cost of living, affordability, interest rate payments that for many people they'll be coming out of 1%ers going into 4%ers, etc. When you accumulate all of that, I think it will just be too much for certain people in that 1.5 to 2 million bracket. There's only a certain level of affordability with the cost of living challenges, and I think that surcharge could be the straw that breaks the camel's back.
Like you say, just echoing that, it could be the policies which didn't happen there which have made the biggest impact on the economy, such as that potential exit tax. And I think that was very welcomed, and I think has led to this being a slightly more passive budget. So in terms of the key points, in terms of the main property points, Rob, let's start with the new mansion tax, let's call it inverted commas, on high value homes. So, what is that? It's properties worth over 2 million. There's going to be a new annual high value council tax surcharge. So the government wanted to steer away from that mansion tax word being maybe a little bit triggering for some politically. So the surcharge is going to be set between £2,500 and £7,500 per year, depending on the value of the home. We'll come back onto that in just one moment in terms of the bandings. This will, increase in terms of an ongoing running cost almost for those houses and flats within that banding, and it's going to really. I think it's going to affect demand in terms of buyers, and it's going to be centred around that 2 million mark, the real entry point of the tax. And I think it's maybe the first restructuring of stamp duty which we might see. It's just an early introducer, just letting the market adapt and adjust to this more annualised cost of ownership of property, whereas typically in the UK, it's been a stamp duty payment on the acquisition, which have been larger than a lot of other countries, but it is a one-off cost, which you're not repeating year on year. So I think a slight adjustment there, the first early adjustment to some possible amendments to how the stamp duty is calculated and operated. That in itself, Rob, creates quite a lot of uncertainty in terms of buyers now, because any buyers now are going to have a very large stamp duty land tax bill, whereas in the future, if that reduces and the costs move towards a more annual approach, I feel that creates a lot of uncertainty in the short term, and how the government is going to try and give some positivity, but also give us a roadmap of any potential future changes.
Yeah, I think that's a really good point. I think one of the big reasons for the slowdown was the uncertainty on what that would look like. And one could argue that what's been implemented is a dip in the toe into the ocean, and not really understanding what the future impacts might be. Because the reality is, if you're a 3 million, 5 million, 10 million home owner, the surcharge, the additional council tax cost, is not really going to be impacting you. if you're someone that's been in a property for many years and it's grown in value and you don't have an income stream, maybe you're elderly, that would have an income and you might look to downsize. So I do agree that if there's another tax, an annualized tax on these properties that's a greater level, or the stamp duty is taken away, that would impact, and that uncertainty still remains. And we'll have to see what happens in the future there.
Yeah, it'd be interesting where that money goes. It's due to raise about 430 million annually for the country. Obviously, council taxes traditionally goes to the local authority rather than central government. I believe this additional money is going to go to central government. Just to raise more in terms of government revenue.
Yeah, and we should be clear, it's only estimated to affect somewhere between 100 and 150,000 properties. 75% of them are London, and if properties are decreasing in value in certain price brackets currently, that could lead to a lower amount because obviously a property goes down in value. So that will also be interesting.
Yeah, it is quite a London-centric tax. I know it's 75% in London, but when you take London and the South East, it actually goes up to 90%. On the flip side of that, though, I would say that it's likely to have a greater impact regionally than in London in terms of those sub-markets, especially at sort of the 2 million, which side of the fence your property falls. In terms of the budget, in terms of further property changes and taxes which have been brought in, there's going to be high income tax on rental properties. So landlords are going to be affected by this in terms of that sort of buy-to-let space, any residential investment blocks, MUFBs, HMOs. So from April 2027, the income tax applied on rental income from the buy-to-let and those mentioned will rise by 2 percentage points. So basic, hire and additional fees will become 22%, 42% or 47% respectively. So it's going to have a little bit of impact there in a market which already operates with some fairly tight margins. So we expect there might be more small scale individual landlords exiting that buy-to-let space, which has been the trend for the last 5 years or so.
Yeah, I mean, that space has been squeezed and squeezed and squeezed, and this is just another squeeze. And unless interest rates can fall quicker than they currently are, there is very, very little return on margin. The cost of debt, the cost of borrowing is too high. The tax implications are now squeezing, and something's going to have to give. So the only light at the end of the tunnel for those buy-to-let investors is the reduction of interest rates in 2026, which I believe will definitely hit the 3.5%. We're likely to see a reduction next week, and I'm pretty sure that will be in the low threes as we go through 2026. So that's the only light at the end of the tunnel. But yes, lots of taxes and less margin.
Be an interesting one, especially as a knock-on effect. There's likely to be some increases in rent, although that's going to be coinciding with the Renters Reform Bill, the Renters Reform Act, which now received royal assent. So those two factors are going to be just causing a little bit of friction against each other, and it's going to be interesting to see how the rental market in particular adapts to some of these changes. And it's just not from one angle, it's obviously from two angles in terms of how the tenancies are undertaken, how the properties are marketed, to some external factors which are causing some rental increases. In terms of stamp duty, it was sort of, like we said, Rob, a budget of what wasn't, which created some of the impacts than what was, and no changes immediately to stamp duty. But like we alluded to, that's going to play on the minds of people in terms of any large-scale property acquisitions and how they financial plan and in terms of cycles, looking to buy, looking to sell. As like we said, buyers are going to want to avoid paying large one-off stamp duty payments if the property taxation by the government is going to alter from a one-off payment model through the stamp duty land tax to maybe a holding model whereby people are charged on an annual basis for holding and owning property. Again, London and the UK has been an attractive place for overseas buyers to invest. As here in London, there's been a one-off payment scheme under the stamp duty land tax, and how that's going to affect those overseas buyers be an interesting one to monitor.
Yeah, I think what's been interesting in 2025, clearly there's been an exit from the UK non-domicile to other attractive wealth jurisdictions and countries. The positive has been the Middle East investment. Broadly speaking now, the Middle East investment in London is reaching 50%. I don't see that trend changing, and I think that will be the foundation for the market moving forward over the coming years, and that probably won't be affected by these changes that we're currently seeing. So I think there can still be demand. It will just look different to how it's looked from a buyer perspective over the last 15 years, a bit of a changing demographic there.
Yeah, Rob, so on one side we've got potential for reductions in the market activity, but on the other side we've got potential for a slightly enhanced level of supply in terms of maybe some more rental properties coming from the rental market to the sales market through the buy-to-let landlords exiting that space. So I anticipate a lot of those factors levelling off in terms of the demand side and supply side of the housing and flats in the property market.
Yeah, I think at the top end, I think everything will be next year on a needs basis, death, divorce, first-time buyers, and your discretionary buyer might take a holding position and see what direction things go.
So, Rob, where do you see the market in 2026? What sectors are going to be on the up, maybe plateauing or possibly shrinking?
I think we're going to have a strong residential bottom end year next year. I'm confident on interest rate reductions. We're going to meet that magic 3.5 affordability level, which really pulls people into the market. So I think on the back of the best part of 1.1 million transactions this year, I think that will grow next year probably by a further 10%, a lot of refinance, a lot of lending. So I think that will be positive. In super prime world, I think another challenging year. It's going to be a really challenging year, and it's all about building sentiment and confidence that the UK is a place to continue investing for Mr. and Mrs. ultra high net worth, and that London is one of the top 3 capitals in the world. And I think that's going to be a moving piece, and I think we're going to have to watch the space like we do and see where it goes. But broadly speaking, I think residentially the UK will have a good 2026.
Thanks, Rob. And just finally, in terms of key takeaways, we've got obviously a shift in the way properties are taxed and property taxation. Some of the mansion taxes we mentioned earlier, uncertainty and the impact of that on how that's going to affect landlords in terms of taxation, the supply of properties, regional concentration of that being in London. 90% of the homes affected by the mansion tax can be in London and the South East. Market behaviours, how is that going to impact properties at 2 million? I think it's going to have a very limited impact on the top end of the market, but I think at that sort of 2 million mark, that's going to be the interesting price point. And potential opportunities for lenders, Rob, in 2026, rates potentially coming down. We mentioned about some more downsizers and new entrants to the market. So I think that those are the key takeaways from the budget.
Brilliant, James. Thank you all for watching, listening, following this year. Record audience, hundreds of thousands. It's been absolutely brilliant, and we're super excited to take you on your super prime journey in 2026, and let's hope it's a good one. Have a safe and happy holiday season, and we will see you all next year. And thank you, James.
Thanks, Rob. Season's greetings to everyone. Rest up over Christmas. See you in the new year.